Hello and welcome to this YouTube channel. My name is Khosrow Sokhanvar, presenting to you trading in financial market based on market cycle methodology. The first thing we're trying to learn is to ignore popular beliefs and accept the reality. The reality that is based on our specific point of view to the market. The first thing to consider is that we consider the value of an asset instead of the price. For example, when Bitcoin was $68,000, many people were talking about $100,000 for a Bitcoin. And we saw that it crashed to all the way to $17,000. And when it was $17,000, many people were talking about lower prices, like $8,000. But we saw that from that price, it went up to $30,000. And also, we're trying to pay attention to experienced people instead of inexperienced people. We try to learn something from people who have been for years in financial markets, and we listen to their advices instead of people around in the street or normal people who have no experience in financial markets. What we are learning is based on supply and demand theory. What does it mean? It means that whenever supply for an asset goes higher than demand, the price will go up. And when the demand goes higher than supply, the price goes up. So we are trying to spot some prices that in that prices the balance between supply and demand is not equal anymore. So we try to figure out whether the demand is gonna surpass the supply or vice versa. Okay, we see here when there is a supply and demand imbalance, and when the price moves, we see profit or loss in market. The first thing that comes to mind is that how can I sell an asset without owning it? Actually, it requires the definition of futures contract. What are futures contract? For example, let's imagine I'm trying to sell a smartphone to you for the price of 1,000 euro. Okay, but not now, 2 months later. Okay, I promise you that I will sell this specific smartphone for 1,000 euro after 2 months. And you promised me that you will buy it for 1,000. Okay, after 2 months, if the price of this smartphone is lower than 1,000 euro, like for example 900 euros, I will be in profit because I will buy a smartphone from the market for 900 euros and will sell it to you for 1,000 euros, and you will be in loss. If the price of this smartphone is, for example, like 100 euros, you will be in profit because I have to sell a smartphone that versus in that time 1,100 euros to you for 1,000 euros. So you pay me 1,000 euros, you buy this smartphone, and you go and sell it in market for 1,100 euros. So you will be in 100 euros profit. So we saw that without owning an asset, we can sell something using this futures contract. So we go to a contract, not actual selling or buying an asset. When we sell something that we don't own it, it means that we promise that sell an asset after a specific amount of time for a specific price. So we are going through a short position. If the price goes lower than our promise, we will be in profit. And this promise can create something called leverage. How does it work? If the value of that contract is, for example, 10,000 euros, I have promised you to sell you 10 smartphones, 1,000 euros each. To ensure that this contract will be executed, I put money to ensure that I will do my promise. Like for example, I put money in this contract, 1/10 of the total value of contract. I put 1,000 euros in that contract, and you also, as a counterpart of this contract, you will put 1,000 euros. Whenever the price moves, at the moment, based on price at that time, I will be in profit or loss. For example, if I'm a seller, if the price goes down, automatically from your money you have put in the contract will be taken and will be given to me, and vice versa, until my 1,000 euros becomes zero and I will be out of the contract. My position will be automatically closed and it will be sold to another person. We saw also profit and losses in future contracts. And another concept that we have to take into consideration is market uncertainty. No one can claim that they can predict the market 100% correct. And we can't predict market for sure. All traders have a certain amount of win rate. For example, what is win rate? Win rate is the number of trades that I'm correct, that my trading strategy works actually, divided to all the trades I'm doing. For example, if after 100 trades I have had 60 take profits and 40 stop losses, I will have 60% of win. And the volume of each trade is very important, because if I risk for a specific trade 20% of my all funds, after 5 trades I will have no money left to continue trading. Maybe the 6th trade that I was gonna do was the trade that I would win. So I adjust the volume of each trade such that I can do too many trades. Like I risk just 1% of my account for each trade, and it allows me to open 100 trades. That 100 trades I can see my win rate. So my win rate will manifest in my trades. Okay, and risk to reward ratio. Risk to reward ratio means when I open a trade, for example, I buy an asset for 1000 euros, I should know that when I'm wrong. For example, I consider the price of 900 as a stop loss. When the price goes down to 900, I will close the trade and I will cut the losses. Also take profit. I put my take profit on 1200. When the price hits that, I will automatically exit the trade with profit, with 200 euros of profit. In this case, my risk to reward ratio is 1 to 2. So for each unit of risk, I expect 2 units of reward. It means that my risk to reward ratio is 1 to 2. Okay, for example, why this is important? For example, if I have a strategy with 50% win rate and I go to the trades with 1-to-1 risk to reward ratio, I will be neither in profit nor in loss. For example, if I open 10 trades, 5 of them will be in profit, 5 of them will be in loss. So for example, if I buy an asset for 1000 euros, I expect the profit at 1100 and my stop loss is at 900. I have opened 5 trades and gained 500 euros. 5 trades, 100 euros each, 500 euros. And I have lost 500 euros too. 5 trades with loss, 100 euros each. It means I have lost 500 euros. So I will be in zero profit. But if I adjust my risk to reward ratio based on my strategy with 1 to 2 risk to reward ratio, and I have, for example, 40% win rate, after 10 trades, I have made 4 successful trades with 200 euros each. It means that I have gained 800 euros for successful trades, and I have lost 600 euros. 6 trades with loss, 100 euros each, 600 euros. At the end of these 10 trades, I will be in 200 euros profit. So there should be always a balance between this risk and reward ratio and our win rate. Okay, we need some tools for our analysis. The first and important one is this website, tradingview.com, that we will go through it in the next episodes. And technical analysis. What is technical analysis? In technical analysis, we're trying to spot the important supply and demand zone, that we call it decision point, or DP, decision points. We're trying to find them. Once I hear from an expert, financial companies and banks will tell their new traders that don't trade at all unless it's in those important supply and demand zones. See the charts, we need to know what are candlestick charts. In this picture, we are seeing a candlestick chart. What do these candles mean? Like this green candles and these red candles. These green candles are called bullish candles. It means that the price has been going up during these candles. Each of these candles represent a specific period of time. For example, if I set the chart to 5 minutes time frame, each of these candles represent the price movement in 5 minutes. If I adjust in daily time frame, this candle represent price movement in 1 day, 24 hours. It has 4 elements: high, close, open, low. What do they mean? The open price in the beginning of this period of time. In the beginning of, for example, if I have set the time frame to 5 minutes, the open price is the price in the beginning of these 5 minutes. Then we can have different scenarios. Like for example, price goes up to this point, goes down to this point, and at the end of these 5 minutes, the price is here. The price at the end of this time, at this 5 minutes, is our close. So we have open, we have close, and we have the body of candle between these two prices. If the close is higher than open, the candle is bullish and the candle is green. And high and low are prices that during this 5 minutes, we have been at those prices, but they are out of this range between open and close in this 5 minutes. So we have high, low, open, close. Or another scenario, we can start from, again, this open price, we go down, we go all the way up to this high, and we close at this price at the end of this 5 minutes. And the opposite candle is bearish candle. And the open price, the price in the beginning of this time period is higher than the close price, the price at the end of this time frame. For example, we go up, we go all the way down, and we close at this price. Open, close, and the lowest price we have seen during this period, highest price we have seen during this period. And we can have other scenarios like go down, go up, again down, and close to this price. What are support and resistance zone? The definition of support is a price zone in which the price has been pushed up at least twice. For example, the price has gone down, pushed up, gone down, and pushed up again. We mark this price as a support zone. What is resistance zone? It's the opposite. A price zone in which the price has been pushed down at least twice. We have gone up, pushed down, gone up, and pushed down again. We mark this zone as a resistance zone. And in the future, when the price goes to this zone, we consider this as a resistance, and we might consider opening a short position or selling an asset in this zone. We will see the examples in the next episodes. Very, very important supply and demand concept. Support and resistance reversal. When I have a resistance, for example, if the price crosses it, it will be a support after that. When the price goes up and goes down to that former resistance zone, it will act as a support for us. Why this happen? Imagine many of traders have marked this zone as a resistance. They open short positions here or sell an asset, expecting that the price will go down, but the price goes opposite of this, their expectations. When the price goes again to that zone, they will close their trades in zero profit and loss. They have been in loss in this period of time, and when the price goes again here, they close their trades in this zone in zero profit. And when they close their trades, when you close a short position, it means that you have opened a long position or a buy position. You have sold something here, the price goes up, you will be in loss, it will goes down to your entry price, and you will close your position. It means that you will buy that asset. And when there is a buy pressure, there will be imbalance between supply and demand will be higher and the price will goes up. And the opposite, when there is a support zone, if the price goes below it, it will be a resistance after. What are trend lines? What is trend? Trend is a sequence of high and lows. For example, the price goes up, goes down, I mark it as a high, and again goes up, I mark it as a low. Again, from this point goes down, I mark it as a higher high. This is high, this is higher high, and from this price it goes up again. I mark it as higher low or HL. So a high, low, higher high, higher low, and so on. If I draw a line from this low to the next higher low, I will have a trend line. And also in a downtrend like this, I will have a low, high, lower low, and lower high. And if I connect with a line, this high to the lower high, I will have a bearish trend line or a downtrend. Okay, in financial markets or in technical analysis, we call uptrends as a bullish trends and downtrends as bearish trends. So it is a bearish trend line, it is a bullish trend line. So the definition of a bull trend or uptrend is that we are forming high and higher high and low and higher lows one after another. And the opposite is true about downtrends or bearish trends. We are forming lows, lower lows, highs, and lower highs. What are break-even points? When I have a trend line train, the price goes up, and with these 2 points, I have a trend line. In the third time that the price hits this line, I expect that the price will go up from this point. It goes up, it goes down. Again, I expect that this trend line acts as a support, but it doesn't. Let's imagine it doesn't. It goes down, it comes up. Many traders in this point have been buying this asset, expecting price to go up, but it has not. It goes down, comes up again, and this point they will be in zero profit or loss, so they will close their position. Many people close their buy position. It means that they are selling an asset, so there will be a sell pressure here. It pushes the price down. So these break-even points are important, and the opposite is true for a downtrend. Thank you for watching this introduction. We will go through all of these concepts in details in next episode. Have a good day.